If you're new to the game, you've probably heard the term moving average thrown around quite a bit. But what exactly is it, and how can it help you make smarter trading decisions? Don't worry. I'm here to break it all down in a way that's easy to understand, even if you're just starting out. By the end of this guide, you'll not only know what a moving average is, but you'll also have the tools to use it effectively in your trading strategy. Ready? Let's dive in. First things first, what is a moving average? At its core, a moving average is a mathematical calculation that helps smooth out price data over a specified period. By doing this, it creates a single flowing line that helps you visualize the overall trend of an asset, whether it's going up, down, or sideways. Imagine trying to look at a busy street filled with traffic. It's chaotic, right? Now imagine if all that traffic were turned into a single, smooth line, showing you the general flow, whether more cars are moving towards the city, uptrend, or leaving it, downtrend. That's essentially what a moving average does for price data. Now, there are different types of moving averages, but let's focus on the two most commonly used, the simple moving average, SMA, and the exponential moving average, EMA. The simple moving average is, well, simple. It takes the average price of an asset over a set number of periods and plots it on the chart. For example, if you're looking at a 10-day SMA, it adds up the closing prices of the last 10 days and divides by 10. The result is a smooth line that reflects the average price over that time. The exponential moving average is a bit more sophisticated. Unlike the SMA, which gives equal weight to all periods, the EMA gives more weight to recent prices. This makes it more responsive to price changes and can be more useful for short-term trading. You might be thinking, okay, I get what a moving average is, but why should I care? Great question. Moving averages are incredibly powerful tools for a few reasons. Trend identification. Moving averages help you identify the direction of the trend. If the price is above the moving average, it's generally considered an uptrend. If it's below, you're likely looking at a downtrend. 2. Support and resistance levels. Moving averages often act as dynamic support or resistance levels. For example, in an uptrend, a stock might pull back to the moving average before continuing higher. Buy and sell signals. Moving averages can help generate buy and sell signals. For instance, a common strategy is the golden cross, where a short-term moving average crosses above a long-term moving average, signaling a potential buy. Is the market trending or mean-reverting? Before diving headfirst into using moving averages, it's crucial to determine whether the market itself is trending or mean-reverting. This step is often overlooked, but it can significantly impact the success of your strategy. A trending market is one where prices consistently move in one direction, either up or down, over a period of time. In such markets, moving averages work beautifully because they help you identify and ride the trend. For example, if the price of an asset is above the moving average and the market is trending upwards, you might look for opportunities to buy. On the other hand, a mean-reverting market is one where prices oscillate around a central value, often returning to a mean after moving away from it. In these markets, moving averages might give false signals, leading to losses if you expect a trend that never materializes. So, how do you figure out if the market is trending or mean-reverting? Here are a few methods. 1. Visual inspection. The simplest way is to visually inspect the price chart. If you see a series of higher highs and higher lows, or lower highs and lower lows, the market is likely trending. If prices move back and forth without much directional movement, it's probably mean-reverting. 2. ADX indicator. The average directional index, ADX, is a popular technical indicator that helps quantify the strength of a trend. If the ADX is above 25, it generally indicates a strong trend. If it's below 20, the market might be mean-reverting. 3. Bollinger Bands. Bollinger Bands can also help identify market conditions. In a mean-reverting market, prices tend to bounce between the upper and lower bands. In a trending market, prices might walk the band, staying close to either the upper or lower band without crossing back. Understanding the market context is crucial because a moving average strategy that works wonderfully in a trending market might fail miserably in a mean-reverting one. Always start by analyzing the market condition before applying your moving average strategy. Now that you know what moving averages are, why they're useful, and how to determine market conditions, let's get into how to set them up. Most trading platforms like TradingView or MetaTrader make it easy to add moving averages to your charts. Here's how you can do it. 1. Choose your time frame. First, decide what time frame you want to analyze, daily, weekly, or even hourly. The choice depends on your trading style. Day traders might prefer short time frames like 5-minute or 15-minute charts, while swing traders might look at daily or weekly charts. 2. Select your moving average. Most platforms will allow you to select from various types of moving averages. Start with the simple moving average to get a feel for it. Adjust the period. Next, set the period for your moving average. Common periods are 10, 20, 50 and 200 days. The shorter the period, the more sensitive the moving average will be to price changes. The longer the period, the smoother the line. Finally, add the moving average to your chart. You should see a line appear, helping you to easily visualize the trend. All right, now that you've got your moving averages set up, let's talk about how to actually use them. Here are some beginner-friendly strategies that incorporate moving averages. 1. The crossover strategy. The crossover strategy is one of the simplest and most popular methods among traders. It involves two moving averages, one short-term and one long-term. Here's how it works. When the short-term moving average, e.g. 50-day SMA, crosses above the long-term moving average, e.g. 200-day SMA, it's considered a buy signal. This is often referred to as a golden cross. Conversely, when the short-term moving average crosses below the long-term moving average, it's a sell signal known as a death cross. This strategy works well because it capitalizes on momentum shifts. However, it's best used in trending markets and might give false signals in choppy, sideways markets. 2. Moving average bounce. Another effective strategy is the moving average bounce. This strategy is particularly useful in strong trends. Here's the gist. In an uptrend, look for the price to pull back to a moving average, like the 50-day SMA, and then bounce off it. This bounce could be your cue to enter a buy position. Similarly, in a downtrend, look for the price to rise to a moving average and then reverse. This could be your signal to sell or short the asset. The key here is patience, waiting for the price to come to your moving average and show signs of reversal before entering the trade. If you're into day trading, the Exponential Moving Average, EMA, might be your go-to tool. Because it reacts more quickly to price changes, the EMA can help you catch short-term trends and make quick decisions. A common setup is using a 9-period EMA in conjunction with a 21-period EMA. When the 9 EMA crosses above the 21 EMA, it's a potential buy signal. When it crosses below, it's a sell signal. This method works well in fast-moving markets where timing is crucial. Like any trading tool, moving averages aren't foolproof. Here are some common pitfalls to watch out for. 1. False signals. In sideways or choppy markets, moving averages can give false signals. You might see a golden cross, get excited, and enter a trade, only to have the price reverse. It's important to use other indicators or price action analysis to confirm your signals. 2. Lagging indicator. Moving averages are lagging indicators, meaning they're based on past price data. This can make them slow to react to sudden market changes. Always be cautious and avoid relying solely on moving averages for trading decisions. Overfitting. It's tempting to tweak your moving average settings to fit past data perfectly, but this can lead to overfitting. What worked in the past may not work in the future, so it's important to test your strategy across different market conditions. While moving averages are powerful, they're even more effective when combined with other indicators. Here are a few that can help confirm your signals and provide additional insights. 1. Relative Strength Index, RSI. The RSI measures the speed and change of price movements and can help you identify overbought or oversold conditions. For example, if your moving average strategy signals a buy, but the RSI is in overbought territory, above 70, it might be wise to wait for a better entry point. Conversely, if the RSI is below 30, oversold, it could confirm a buy signal from your moving average. 2. Moving Average Convergence Divergence, MACD. The MACD is another popular tool that complements moving averages well. It shows the relationship between two EMAs and can help confirm trend changes. For instance, if your moving average strategy signals a buy and the MACD line crosses above the signal line, it adds more weight to the buy decision. 3. Bollinger Bands. Bollinger Bands consist of a moving average with upper and lower bands that measure volatility. If the price touches the lower band in an uptrend and bounces off the moving average, it could be a strong buy signal. On the other hand, if the price touches the upper band in a downtrend and reverses at the moving average, it might be a good time to sell. Let's pull all these concepts together into a simple trading plan you can start using right away. Start by analyzing the market to determine if it's trending or mean reverting, using visual inspection, ADX, or Bollinger Bands. Choose your time frame based on your trading style. Select a simple moving average, SMA, or exponential moving average, EMA, depending on your preference. Use a combination of short-term and long-term moving averages for crossover strategies, or a single moving average for bounce strategies. 3. Use additional indicators. Add RSI to identify overbought or oversold conditions. Use MACD for trend confirmation. Incorporate Bollinger Bands for volatility analysis. For a buy signal, wait for a golden cross or a bounce off a moving average, confirmed by RSI and MACD. For a sell signal, look for a death cross or a price rejection at a moving average, confirmed by the indicators. Risk management. Always set stop losses to protect your capital. Consider using a trailing stop to lock in profits as the price moves in your favor. Moving averages are a fantastic tool for traders of all levels, offering a simple yet effective way to analyze price trends and make informed trading decisions. However, like any tool, they work best when used in conjunction with other indicators and a solid understanding of market conditions. Before you jump into the market, make sure to practice with a demo account to refine your strategy and get comfortable with your chosen setup. Remember, the key to success in trading isn't just about finding the perfect tool. It's about knowing how and when to use it. Happy trading!